Jay Adams sent this question in on Facebook. I'm finally starting to get back on my feet and want to start saving again. Should I put all of my money in one place? That's a fantastic question. I'm sure a lot of you have the same question. But let's look at the concept of saving first. Traditionally, when you saved money, you would take your excess earnings and you would store it for later use with the idea that you would maintain its purchasing power. Well, today we live in an extremely volatile economy where we see high inflation and a rapid loss of the dollar value. So maintaining more than an emergency fund in a savings account isn't really a good idea. So how much do we keep in an emergency fund? About 3 months worth of your expenses. Beyond that, we have to examine some other investment vehicles. Well, how do we do that? I say we follow 3 simple rules. The first rule is choose the appropriate vehicle. And that vehicle is going to be based upon what your desired outcomes are. So there are precious metals, there are stocks, there are bonds, there are mutual funds, and some people even like to keep their money in cash. However, if we're trying to get a big return rapidly, then cash or gold or bonds aren't necessarily good strategies. Cash, as we said earlier, is losing money rapidly. Gold means it doesn't pay any dividends and has to be sold at a higher price than what you bought it at, and bonds take time to mature. So when we choose a stock, bond, or mutual fund, we're also going to look at something short-term as opposed to long-term. In the past, people would say, invest your money and forget it. Well, because the economy is extremely volatile, we can't just forget it. We want to look at an investment of about 1 year or slightly longer. So after a year, we would examine it and see if it still makes sense to keep putting money into it. And the reason we use a year is to make sure that we take advantage of what we call long-term capital gains tax. We want to get the most money out based on the money that we put in. The third thing we're going to do is get out at the right time. And how do we do that? We choose a predetermined exit strategy. The exit strategy will be based on a duration, and you could say for 1 year, and we want to look at 1 year, not less than a year, so we can take advantage of long-term capital gains tax. We also want to get a predetermined return on investment. So if we're looking for a 30% return, when it hits 30%, we get out no matter what. We don't get greedy and keep pushing and pushing because the economy could change and we could lose it all. We also have a predetermined low point. So if 15% is the low that we're looking for, if it drops down to 15% within that year, we get out no matter what. We don't try to wait for it to turn around. So using those 3 simple rules, you'll find that it's easy to find a place to put your money in. However, until you find it, don't pull the trigger. Be patient.